the ultimate Dividend King Stock tier list. What is happening, investors? It is your boy Jack. I'm not a financial advisor. I have the mug with coffee inside of it to prove it, and today we're going to be speaking about some dividend stocks. I haven't been showing dividend stocks the most love as of late, I'll be completely honest, people. My biggest interest as of late, fall into both tech and EV companies, and my dividend stocks just haven't been getting the love. But my ultimate goal with my portfolio still is, to retire off dividends, essentially. That might sound weird considering that I'm putting nearly all of my money into growth stocks right now, but the ultimate goal, decades down the line, is to retire off dividends. So, Dividend Kings, a special kind of company. These are S&P 500 companies who have been paying and increasing their dividend for over 50 years. All of these companies have survived crash after crash. They have always been in somewhat financially stable positions, at least to the extent where they can afford to reward their shareholders with a dividend. If you're not familiar with how these videos work, I've done them on electric vehicles, the most popular Robinhood stocks. We are going to essentially rank these companies on a scale from super amazing all the way down to stay away. So right before we get into the list, can I please ask you to smash a like on this video, as it genuinely helps me out absolutely massively. Drop me a comment after you've watched this video till the end. Let me know, if you agree with me, if you would change the position of any of these companies. And of course, subscribe if you're new around here. Hit that red button, join the family. The road to 20,000 subs is on, people. With that being said, let's get straight into the list. So here we have it, guys. There is 15 companies, and we're going to rank them either super amazing, amazing, quite good, mid-tier, meh, or stay away. Now do keep in mind, the main reason you would invest in any of these companies is for their dividend. So I'm going to be ranking them in the minds of a dividend investor. I'm not going to be comparing them to growth stocks or tech stocks or anything of the sorts. I'm purely going to be basing them off what I believe they should be in regards to a dividend stock. As of right now, there's about 30 Dividend Kings altogether. Today we're going to have a look at 15 because it would be like a 40-minute video if you went through every single one of them. But there'll be some familiar names in here, some you may not be as familiar with. We have 3M, Altria, Coca-Cola, Colgate, F&M Bank, Federal Realty, GPC, Hormel Foods, J&J, Lowe's, P&G, SJW, Sysco, and Tootsie. A lot of different companies. So in no particular order, we're going to start off with our first one, which is actually 3M. So 3M, a very, very popular dividend paying company, okay? On the 6-month chart, they're down about 13.24%, so still down a considerable amount. On the year chart, it's a very, very similar story. If we go over to the 5-year chart even, they're pretty much at exact break even. Now, that obviously doesn't account for dividends reinvested, but still. They have a current dividend yield of 3.74%, so it's decent, Generally, a dividend investor wants 3.5+%, so this falls into that category. They have a market cap of 90 billion and a PE ratio of 18.46. And these guys have been paying and growing their dividend for 62 plus years. And they have, in fairness, been growing that dividend relatively quickly, an average of 8% every year for the last 20 years. So right now it's at 3.74%, but there's a very, very real possibility that this could easily be a 4+% dividend in the future. Now, the main thing that worries me about 3M as of right now is obviously the fact they've been downtrending since 2018. They're down nearly 40% from 2018 levels. They're also in a relatively struggling industry, and it probably will be a struggling industry for a little bit more time, and that is industrials. Where we stand right now, I see a shaky little while going forwards for these guys. This is probably quite controversial, but I am honestly going to put them into quite good. I just don't think they quite deserve that amazing spot. I do think, however, someday in the future they could make their way up here. Now, Altria, this is an interesting one. It's actually the biggest position I hold in a dividend stock as of right now. Altria has an 8+% dividend yield right now. It's massive. Now, another company who has been struggling, okay? These guys since the middle of 2017, since then down nearly 50%. On the yearly chart, they're still down 17.48%. Now, obviously, in these videos, I can't go into detail in regards to why. There simply isn't enough time. I do, however, have a full video on Altria if you would like to check it out. They are quite an interesting company, but I will just make it short and sweet. The main reason I really like them at these price points is because I personally think, from a long-term point of view, they're undervalued. They also have an absolutely fantastic dividend yield. Remember, we're speaking about dividend-paying companies today. They're in a lot of up-and-coming industries. Now, for me, they do definitely carry some risk. They're not the most traditional dividend stock in the world, There is a little bit more volatility with them in general. But for me, they are going to go into amazing. I really like them. Okay, next up we have Coca-Cola, another company I do own a small position in. And I have to be honest, as of late, I've been considering selling my position in Coca-Cola because I think there are far better places I could put that money. On the 6-month chart, Coca-Cola is still down 23.4%. They're still down an awful lot. They have a dividend yield of 3.59%. They have an uninterrupted dividend streak of 58 plus years, which obviously is very nice. On the 5-year chart, they're only up 10%. Now, at the peaks, they were only up 45%. Now obviously that's not including the dividend reinvested, but still, it's been a lackluster performance. Now, I do still see a world where Coca-Cola could be, you know, a much bigger market cap than $196 billion, a much bigger share price than $45.72. But as of right now, there's nothing really special about them. As I said, I'm actually considering selling my position in them because I think that money could be spent better elsewhere. So for me, I'm going to put them into mid-tier, okay, because I do see why you would want to invest in them. As a dividend-paying company at this price, it is probably a relatively safe investment, but there's nothing very exciting about them. Okay, Colgate. 6-month chart up 5.73%, so it's been a decent performance. But then we go to the 1 year and they're up 0.5%. And the 5-year chart, it's been all over the place and they're only up 10%. And they only have a 2.37% dividend yield. Now, up until the last 5 years or so, there has been some really nice growth for this company. It's undeniable. There's been some really good periods of growth. But the last 5 years have been very lackluster. They've left a lot to be desired and they don't have a particularly great dividend. There isn't necessarily anything wrong with this company. I mean, they're in consumer staples, which generally is a good thing for dividend paying companies. They have a decent history. At least they don't lose value very much. But I mean, the dividend isn't great. Okay, so for me personally, I'm actually going to put them into meh, just because I think they're a little bit worse than Coca-Cola. Okay, F&M Bank. So this is Farmers and Merchants Bancorp. You can see a dividend yield of 2.03%. I mean, there are some good things about them, but I just don't see it as a great place to put your money. They're a locally owned and operated community bank with 32 locations in California and has a market cap of $563 million and low liquidity. They have paid uninterrupted dividends for 85 consecutive years. It's currently at about 3.19%. I can't really say I have any interest in them whatsoever. I'll put them into meh. Federal Realty Investment Trust. 6-month chart down 38%. 5-year chart looks ugly as well. Max stock chart, last time we came out of the Great Recession it was fantastic. Aside from that, there's nothing too special. It has literally been coming down since 2016 big time. Now they do have a big dividend yield of 5.28%. They only have a dividend safety of 60. And again, a relatively small market cap of $6.06 billion. And the forward payout ratio is 108%. They do have that 52+ year dividend streak, so again, I do think the dividend is quite safe, but the company itself is struggling. Like, I can see why you might take the risk at this valuation, at this price point, but it is still at a PE ratio of 17.51, so it doesn't seem to be particularly undervalued. So for me personally, again, they're just going straight into meh. They're just not very exciting, are they? I know there's a 5% dividend yield, but meh. GPC. A lot of you guys more than likely know who these guys are. The Genuine Parts Company. 6-month chart down 14%, so not the worst in the world. 1-year chart down 18%. And again, 5-year chart just very choppy, but ultimately they are down. But again, they have that dividend of 3.7% essentially. And on the max stock chart, it has just been slow and steady growth for the most part, except for the last, 5-6 years. Forward payout ratio 78%. It's okay. Dividend streak 64+ years. Very nice. Net debt to capital 56%. I mean, it's not the worst in the whole world. They are also currently trading at a PE ratio of 21.02. Now these guys, it is in the name, okay? They're engaged in the distribution of automotive replacement parts, industrial replacement parts, office products, and electronic materials. So, people are going to need these things. I can't say I have much time for them, but I don't want to put them into meh. I'd put them mid-tier, but borderline mid-tier. Hormel Foods, interesting one. A 1.9% dividend yield, but a 99 dividend safety score. Payout ratio and forward payout ratio are quite good, and they seem to be quite recession-proof. On top of that, on the 6-month stock chart, they have made highs of 7.5%. On the 1-year stock chart, it gets a little bit better, nearly 20%. And we go to the 5-year chart, and we're up about 70% before dividends reinvested. And if you would have invested in them 10 years ago, you could have been up, close to 400%. So a Dividend King, who does actually have a decent bit of history growth-wise, who has good payout ratios, who seems to be in an okay position, they do, however, only have a dividend yield of 1.9%. 54+ year dividend streak. The last 20 years, they're growing at 10% per year on average. And that's stood true pretty much to the last 5 years and the last year. So this seems to be a very consistent number, which does mean that at some stage in the future, they could pay a very nice dividend. Now, to me, if I was a dividend investor, even if I did think it was quite a good company, 1.9% isn't very much, okay? I probably would put them into quite good if that dividend was somewhere around the 3% range, but for now I'm going to have to put them into mid-tier. It's just too low of a dividend, simply put. Johnson & Johnson. One that everybody knows and loves. 6-month chart, we're pretty much at break even. The 1-year chart up close to 10%, and the 5-year chart up 46%. Now to me, as far as dividend paying companies goes, Johnson & Johnson is one of the best. If that dividend was 4+%, I mean, it would be amazing. Just look at this, the payout ratio is low, the forward payout ratio, despite where we are, is low. The net debt to capital is low. The dividend streak is 57 plus years. Last 20 years, 10% dividend growth per year. They're doing everything right. They're at a PE ratio of 22.81, which obviously traditionally is a little bit high, but personally I think it's decent. If I was to be investing in a dividend stock for retirement, okay, even though they're a little bit low on dividend compared to where I'd like it to be, they're only at that 2.76%. To be honest, I would have to put them into super amazing, because by the time retirement rolls around, I 100% believe they will have a 3.5 to 4+% dividend if they keep growing at this rate. Not to despite the fact they have better growth than a lot of other dividend kings. I mean, they're one of the fan favorites for a reason. It's because they are tried and tested and they have performed well. So straight up in the super amazing, well done Johnson & Johnson, you get to stay there. Lowe's. Dividend yield 1.58%, dividend safety of 93, low payout ratio, which is good, and then 57 plus year dividend streak. And again, growing that very quickly, which is important because it is such a low payout right now. 6-month chart, this company is actually up 15% for a dividend king. That is fantastic. 1-year chart 28.5%, and the 5-year chart 105%. I mean, as far as a dividend paying company goes, Lowe's is performing immensely. The only thing is, they only have a 1.58% dividend yield, which is far lower than a lot of their competitors. Again, if that was a little bit higher, I would more than likely put them all the way up into super amazing. And as well, they're in consumer discretionary, which has been known to be more volatile than the staples in the past. So as of right now, I'm going to put them into quite good, but to be honest, I could see myself putting into amazing very easily if it was a 2.5+% dividend yield. Okay, Procter & Gamble, currently at break even on the 6-month chart. We're up ever so slightly on the yearly chart, 7.5%, and we're up 50.96% on the 5-year chart. So with dividends reinvested that are currently at 2.5%, that would be decent. Right now their forward PE ratio is 24.5, which is a little bit above the 5-year average, so it might be a little bit pricey now, but to be honest, I do still think they're one of the best players out there. Now they've shown some good growth in the last 20 years, but it has slowed down quite a lot over the last 5 years. If I could only choose Johnson & Johnson or Procter & Gamble, I personally would be choosing Johnson & Johnson. So I don't want to fill up the super amazing tab, and it's for that reason I'm actually going to put them into amazing. Okay, SJW Group. In water utilities, a dividend yield of 2%, a dividend safety of 99, a payout ratio of 70%, forward payout ratio of 61%, and a dividend streak of 53 plus years. 6-month chart still down 9%. 1-year chart barely up. Max stock chart again, for the most part there's been some nice growth, there's been some slow times, it is what it is. But for me personally guys, I don't really have any interest in them. I've looked into them briefly before in the past and they didn't excite me whatsoever. I'm going to throw them into meh. Sysco, okay? I love Sysco. Dividend yield 3.4%, safety of 55. Understand that pre the virus they were rated at 92, and right now their forward payout ratio is 153%, so it's very high. But do remember they have a dividend streak of 51 plus years. They're going to want to keep paying that dividend. Now these guys are the biggest global distributor of food. Everyone's always going to need their food. On the 6-month chart, okay, down 35% still. PE ratio at just about 20. Dividend yield still at 3.4%. I'll show you the 5-year chart. Before the crash, there was some really nice growth. I'm speaking 132% growth with a dividend yield of 3.4%. I mean, that's some fantastic growth for any company. And in the max stock chart, we can see that over the last 10 years, again, that's been even better. I really like them at this price point, but it could be a few years before we see a lot of the return. But from a dividend investor's point of view, it's 3.41%, and I personally do believe it's safe. I know they've fallen on tough times, but I think they're going to pull through just fine. Honestly, for me, this might be weird to a lot of people. I would put them into the amazing spot. I mean, the growth's been really good, the dividend is nice, the safety is somewhat there. I love it. And the last one we have is Tootsie Roll Company. So you probably know these guys, if you're in America especially. Their best known products have been Tootsie Rolls and Tootsie Pops. 6-month chart, absolutely all over the place. Break even. 1-year chart, absolutely all over the place. They're down. 5-year chart, they are up 17.5%. They only have a dividend yield of 1%. They have a PE ratio of 33.61, a market cap of 2.3 billion. Now, historically, they've had some slow and steady growth, but I mean, it really hasn't been anything special, okay? 2000, if we take an average price of 2000 and go up, it's up 56.67% in 20 years. I honestly see no reason to invest in this company. The dividend is low, the growth is very low. Like, why would you put your money into them? I would rather put it into any of these companies. So for that reason, I'm going to put them in to stay away. I mean, unlucky, there is nothing exciting about this company. Now, possibly the hardest bit of the video, we try and put everything into the exact order I would like to invest in. So quite easy, J&J is up at the top. Me personally, I prefer Altria to PG. But if I'm going just off dividend, I would put PG first, then Altria, then Sysco. Quite good. 3M to me definitely beats Lowe's. Mid-tier, again, I'm actually going to leave in this order. Coca-Cola first, then GPC, then Hormel. Now, honestly, none of these really interest me. If I had to buy any of them, Colgate would probably be first, then the Realty, just because it's been battered down so hard, who knows, there could be some growth potential. And then these two, yeah, I'll leave them in that order, that's fine. And then Tootsie is last. There we have it, guys. In general, when I speak about dividend paying companies, the videos don't do very well. That's just the way it is. They're not as exciting to a lot of people. If you watched till the end, I really do appreciate you, and I would love to ask you both to drop this video a like and drop me a comment down below, because those two things could help the video do better, which would really make me feel better about continuing to make these styles of videos. Either way though, guys, I really do hope that you enjoyed today's video. Subscribe if you're new around here, please. It means an awful lot to me. I hope you have an absolutely fantastic day. Peace.